All right, hello everyone, and welcome to the NinjaTrader ecosystem webinar room. Before we get started, I do want to do a quick test of picture and sound. So if you can clearly hear my voice and see the projection in the room, please type the letter Y into the chat box now. All right, looks like I'm getting some confirmations here. I do want to change something here, but if you all can hear me, that's fantastic. Appreciate the confirmation. I want to thank everyone for joining us today. My name is Jared Meyer, and I work on the NinjaTrader ecosystem development team here at the Denver office. We have a very special event for you today with Mr. Manesh Patel of Ichimoku Trade. All right, and before we get started, I do want to just, before we get to that part of it, I just want to ask everyone in the room a quick poll question. So if you could just choose option 1, 2, 3, or 4, that will help us identify what type of folks we have here in attendance today. And while you fill that out, I do want to mention that it is important to understand that there are substantial risks in trading commodities, futures contracts, and Forex. You should carefully consider whether such trading is suitable for you, and that will depend on your specific circumstances and financial resources. It is possible to lose all the funds deposited with your broker. You could even incur losses beyond these amounts. And we do encourage you to inquire at the link I'm going to post in the room here in just a moment for more information or for a copy of the CFTC full risk disclosure. Also, please do know that these training webinars are not a solicitation or recommendation, but simply educational in nature. And also, please know that this presentation is presented by NinjaTrader, this presentation is presented by NinjaTrader LLC, which is the technology company responsible for developing and supporting NinjaTrader trading software. If you have brokerage-related questions, they should be directed to our NinjaTrader brokerage team at the phone number I'm going to post in the room here just in a moment, or by emailing the address here that I'm posting as well. All right. Looks like most everybody's filled out an answer to the poll question. I appreciate that. And we want to review the results and give you some items to take action on should you be interested here in just a moment. All right, so it looks like we have about 40% of the folks that are lifetime license key holders. Fantastic to see you all at an event. I hope that to see you again in future events as well. The next, it looks like we have a tie with free license key holders and folks not yet using NinjaTrader, so I have something for both of you here in just a minute. And I have some folks, about 6% that are leasing a live key. So if you've not already done so, I would invite you to download NinjaTrader for free from the following link here. I'll post that in the room. And for those of you that maybe are using the free version or have not looked at our using our license, or losing our platform, you can go ahead and check out that by this link here. So those are the links that you can check out options for utilizing the platform then. So I'm going to close the poll. Appreciate everyone taking advantage of the poll and answering that and doing that with us. And now we are very excited for this unique event in which Manesh Patel of Ichimoku Trade discusses iMTF technology and how to trade using multiple time frame analysis with one glance. Thank you for your attendance today. Without further ado, it is my pleasure to welcome to the NinjaTrader ecosystem webinar room Manesh Patel. Please take it away, Manesh.
Okay, can you hear me okay? Just a quick sound check. Jared, are you okay? Okay, perfect. Okay, I want to welcome everyone. Thank you for taking the time out of your busy life to attend this workshop. I also want to thank NinjaTrader for setting up this workshop too. Believe it or not, this is our first product launch with NinjaTrader ever, and we're very, very excited. We've been involved with the NinjaTrader community for years indirectly, but this is the first time we're actually going to be supporting it from this point on directly now on. As you can see from the title, the workshop is about multiple time frame analysis at one glance. Today, a lot of traders still look at one time frame. Some look at 2 or 3, but that's about it. The reason why most traders shy away from multiple time frame analysis is because it is confusing. Sometimes the higher time frames influence the lower, and sometimes the lower time frames influence the higher. Also, which time frames are the key time frames to trade? Some people think it's 1 minute, some people think it's 3, some people think it's 60, some people think it's 240, and so forth. Today, we're going to take the mystery away. We're going to do multiple time frame analysis where we're going to look at all the time frames from 1 minute all the way to monthly time frame, all within seconds. We're going to do this with our artificial intelligence technology called iMTF, which stands for Ichimoku Multiple Time Frame Analysis. With this technology, a trader can easily see the multiple time frame support resistances, plus do a lot much more. Before we begin, let's go for our normal disclaimer. This agreement basically states this workshop is for education use only. We're not soliciting a buy or selling a particular instrument. If you do so, you're doing that all at your own risk. All information for this PowerPoint is owned by EII Capital, cannot be copied or distributed without our written permission. We are broker charting neutral, but today we're going to be talking about NinjaTrader and illustrating everything in NinjaTrader for the iMTF indicator. So let's begin. Here's my information about me. You can find everything about me on the internet because we publish it so people can validate us and see the career path I've taken. If you look at everything, basically it states that I graduated with my master's in electrical engineering in 1996. I pursued a career in telecom sector for over 12 years, working for a lot of major companies like Lucent Technology, Bell Labs, and so forth. While working as an engineer, I started to trade as a hobby. So trading was a hobby for me, not a full-time career at that point at the beginning of 1996. In 2007, I left the telecom industry permanently and pursued a career as a trader. I started to work for an institution to manage stocks and currencies right away, eventually became the CTO for that firm due to my technology background, and also we were creating high-frequency machines in that firm too. I left the financial industry late 2010, and then I started to pretty much manage my own money, and that's pretty much where I sit today. I pretty much manage my own money, don't manage other people's money or anything like that at all. Today I trade every instrument in the world, from currencies, US stocks, US futures, UK stocks, Indian stocks, Australia, and so forth. I basically go where the major trend is taking place. We use our artificial intelligence technology to filter out the noise worldwide so we could concentrate on the real potential opportunities that exist. This is exactly what we're going to show you today, is how do we do that. If you do have any questions, please put them in the chat room. We'll try to get through all the questions as we go through the webinar and the workshop, but for some reason if we don't, we'll follow through later on with the questions, with answers and so forth. Okay, so what exactly are we going to talk about today? As we mentioned, we're going to simplify multiple time frame analysis in the form of a technology called iMTF. The iMTF technology, it looks at what all the day traders, swing traders, and long-term traders are thinking and illustrates everything in a very simple visual picture. From a high level, if you think about what multiple time frame analysis is, it is basically a timing element. We always hear about people talking about price, but we never hear about people talking about time. Today we're going to talk about both price and time. Believe it or not, when price and time are combined together, they give a trader a high probability. Why? Time is very critical. If you're trading in a trend, when it's occurring, you have a high probability of success because you're trading in the direction of price, compared to when you're trading in a consolidation pattern, which has a lot of volatility in there and price is moving in a sideways action. When all the time frames are aligned, believe it or not, it tells you that you have a timing element that's occurring and you have a higher probability of success compared to trading any outside of that scenario. And we'll prove that to you as we go forward We give you the rules, and we'll go for a lot of charts and everything later on. Talking about multiple time frame analysis is irrelevant if we don't talk about it in terms of real trading. A lot of people talk about theory, but today we're going to put it to test, and we're going to actually give you a trading plan and so forth. This is a trader's workshop. As a result, we're going to show you how to take the iMTF technology in respect to all the trading blocks that you see here that we're about to go through. Okay? You will know when to enter. You will know what the sentiment is for an instrument and time frame. You'll get to know what the key support resistance levels are. In this workshop, we'll discuss where the entry pullback are, where the entry breakout levels will be. We're going to show you exactly where to enter, where your stops should be, your initial stops, where your trailing stops should be, where you will take some profits off the table. We call that a terminology called preserve mode. We do that so that you don't go for a scenario of going round trip at all. Then you will talk about targets. We'll talk about money management. When we talk about money management, we're specifically going to talk about reward risk, where we're going to be talking about maintaining a 3-to-1 reward risk ratio. Optimization, we'll talk about how to optimize, whether it be the iMTF indicator, or you could even optimize with other technical systems that you're using too, from Fibonacci to Elliott Wave to Harmonics and so forth. And then we'll also give you a complete trading plan for both breakouts and pullbacks. And then we'll talk about consistency in order to achieve success and so forth. So this basically gives you a summary of everything we're going to do in this workshop. The first place we're going to use the iMTF technology is going to be in terms of finding key support resistance levels. Why? If you think about it, trading is all about recognizing key support resistance levels and then placing a trade as close as possible to these levels. The closer your entry is to the key levels, the lower the risk and the higher the reward risk. The sole purpose of thousands of indicators that exist today is to find key support resistance levels. The problem that you find in that statement is the word key. How do you find these key levels? Most people look at one time frame with an indicator or a set of indicators. Then you find the support resistance level for that time frame, and then you trade the probabilities off that time frame. Some people use 2, or some people use 3 time frames, and at most, and then they basically trade those probabilities. Today we're going to change your thought process as a trader with the iMTF technology. So you're first going to look at the trader's issues, finding these support resistance levels, and then solve them. So today we're going to examine how you're going to do multiple time frame analysis in a couple of steps, where it's going to be done in a matter of seconds, not a matter of minutes. And you're going to see the huge advantage that you have in doing multiple time frame analysis compared to scrolling backwards or looking at 1 or 2 time frames. And you'll see exactly what the probabilities are in doing that too. So let's examine some of the issues traders face on a daily basis or a weekly basis or so forth. Problem 1 in that you face as a trader in recognizing key support resistance levels are as follows. I got a little visual diagram here, and basically on the left is a trader trading off a 60-minute time frame. This is his trading time frame. Some traders trade off 1 minute, 5 minute, and so forth. For example purposes, we're going to say it's a 60-minute for now, but it could be any time frame that you like it to be. The trader recognizes there is a trend. He puts a pullback trade at the black solid line because he recognizes that to be a major support. The stop then is going to be a buffer below that black line, which is, it's not there right now, but it's basically the stop will be a buffer below the black line. And basically what he's looking to do is enter at the black solid line, purchase this, and then he looks to least for price to retest the pivot high. That is the goal for the trader. Instead, what happens is that price breaks the support, it goes down to his stop, as you can see here, and then takes off in the direction that he had planned it to go. So what happened? He got clipped basically in this trading scenario. Has this happened to you? It has happened to every trader out there, believe it or not. You can't really call yourself a trader unless you've gone through this at all. So what did you do wrong? A lot of people ask this question. A lot of people think, well, do I need another indicator? Did the broker play games with me? Are there some other thought process that may occur in the trader's mind? The only question you should be asking is, why did this occur? A lot of people come up with excuses, but they really can't figure out why this occurs. Today you're going to know why this occurs, and I'm going to show you through some visual illustrations on what happened. For this example here, what happened? In this example here, you had your support and then you got stopped down in a 60-minute. Then you have the daily time frame. So in this situation here, price went to the daily support, which is exactly where the 60-minute trader had a support, the stop. It got to the daily support and then bounced off it, and price resumed the bullish trend. In this case, the higher time frame support overrid the 60-minute support. The long-term traders decided to show up to trade on the pullback, and they came in with a lot more volume compared to the 60-minute trader. Based on this, a trader will assume the higher time frame is always important and critical. Okay? And this is pretty much a notion that a lot of people think that you should always trade with the higher time frames. Well, that's one situation. The second situation could be is where you have your pullback trade on the black line, but what happens is price never got to that level at all. Instead, it stopped midway and then it decided to take off. So what happened in this situation? You didn't lose anything, but you never entered the trade at all. In this situation, what happened is that price stopped midstream because that's where the 30-minute support was. So in this example here, the lower time frame was basically the dictating time frame that controlled the support. Price decided to respect the 30-minute support instead of the 60-minute support. The day traders decided to show up to trade, whereas the swing traders and the long-term traders didn't trade with volume to influence price, so the day traders won as far as the support is concerned. So you have two different situations here. Problem one was where basically the higher time frames controlled the trade, controlled the support. Problem two, it was a different situation in that the day traders, the lower time frame, controlled the support. So you have two different thought processes that are going on. So which one is correct? If looking at both situations, you have some randomness that's going on. You don't know what type of trader is going to show up to trade with volume and influence the instrument. There's no statistics, believe it or not, behind it. In order to trade the probabilities, you have to assign rules to randomness, and that's what you call a trading plan. In order to resolve this situation, we're going to look at the 30, 60-minute, and daily support to be the same. So what we want to do is, if it is the same support for all three of those time frames, then you have a multiple time frame match. In order for this to occur, the 60-minute, the 30-minute, and the daily traders have to think the same way. When this occurs, this is a high probability situation because all the day traders, all the swing traders, and all the long-term traders have the same support, so you don't get into these situations where you're going to get clipped or you could miss the trade and so forth. Your probability of thinking this does not occur. Most people think that this doesn't occur that often. The problem is that most people do not think about the time frame matching or know how to do this. Some traders have attempted to do this through Fibonacci clustering, but that is for a certain number of time frames. Also, you have to do a lot of work to find these levels. Most of the work is done on the current bar. Do this multiple time frame matching in the past is extremely difficult by hand and requires a lot of computing power for any instruments in multiple time frames. Today we're going to change everything. We're visually going to show you these levels for any instrument and any time frames by analyzing everything from 1 minute to the monthly time frame, and we're automatically going to do that for you and show you a visual image of where these levels exist. So you don't have to do any of that computation at all. So the solution is going to be the iMTF technology. Before we get to the chart, let's explain what's going on behind the iMTF technology. From a high level, we need to represent the support resistance for all the types of traders. We're going to classify the types of traders in three categories: day traders, swing traders, and long-term. Okay? So if you look at this bucket here, the bucket represents all the support resistance for all the traders out there. First type of traders we're going to basically represent in that bucket are the day traders. you have, and then the swing traders and the long-term traders. So when we find a key support resistance levels, you have to make sure it represents all three types of these traders. If it doesn't, it's not going to be a major support resistance level at all. Okay. Now, let's dig a little deeper. Let's look at each individual bucket. When we talk about the day traders, we need to look at all the day traders out there. Okay, the day traders include a variety of traders out there. We're going to classify the day traders into three subcategories, and we're going to look at the time frames related to each. The first zone for the day traders is going to be the lower zone, which basically includes the scalping time frames such as 512s, 1024, and so forth, 1 minute, 3 minutes, all the way up to 5 minutes. The second zone of day traders are the middle day traders, where are trading 6 minutes, 7, 8, 9, and 10. And then the upper day traders are trading more towards 12, 15, 18, and 50 minutes. So this day trader bucket here, when we look at all the day traders, we're going to look at all the day traders from 1 minute to 50 minutes because there's different types of day traders in there. And our goal is to find the time frames, find the instruments where are matching supports between 1 minute all the way up to 50 minutes. When it does, that's when we say the day traders are thinking the same way. We're going to take that same solution and we're going to do that also with the swing traders. For the swing traders, we're looking at the 60 minutes, 120, and 240. Okay, and we're going to basically analyze the 60, 120, 240, and we're going to find all the instruments that basically have the same support resistance levels for these three time frames there. When they all match, we're going to say the swing traders are thinking the same way. Okay. The third type of traders is the long-term traders. This includes daily, weekly, monthly, and time frames. And let me show that to you there. The goal of the AI day trading engine is to analyze these time frames here. Okay, so for the long-term traders, we're going to make sure that the daily, weekly, monthly match for support resistance. When they do, then basically we're going to say the long-term traders agree. Now, how do we represent this? We are analyzing 1 minute all the way up to monthly time frame. How are you going to analyze this? And then how do you represent this on a chart where people can understand this? You want to represent this on the current bar, but you also want to show how this multiple time frame support resistances are in the past, so you can see how these past iMTF levels influence the future too. So this is what we've done with the technology. What we did was we grouped the day traders and the swing traders together. So when the day traders and swing traders are thinking the same way, we're going to represent it through a purple dot. Okay, and wherever that purple dot is, that's the price level where all the day traders and swing traders are thinking the same way, where they have the same support resistance level. That's one level. The second level we're going to look at is where the swing traders and the long-term traders are thinking the same way, and we represent that through a black cross. Okay, so the black cross represents when the swing traders and long-term traders have the same support resistance levels. The purple dot represents when the day traders and swing traders have the same support resistance levels. Why did we separate these into two groups? Well, if you think about it, not all the traders are the same. Some traders are conservative, some are aggressive. So this is why we did that. And we'll explain this approach in just a moment. Okay, so let's look at day traders' probabilities. If you have a purple dot at the current bar, it gives you an average probability right there. So if you're a day trader and you have a purple dot at the current bar, it's an average probability. If you're a day trader and you have a cross as a support resistance, then basically that gives you a higher probability compared to the purple dot. If you have a dot and a cross, and sometimes they could be displaced a little apart from each other, that gives you the highest probability. Why? You're in the day trading time frame. If you have a purple dot, that means the day traders and swing traders all agree, and that's the support resistance level you have. If you have a cross that tells you you're day trading in the direction of the swing and long-term traders, which gives you a higher probability. Okay? If you have a dot and cross, that tells you all three types of traders, day traders, swing traders, and long-term traders, are thinking the same way, they have the same support resistance, and now you have the highest probability. That's why you have the best probability when you have dot and cross on the current bar. Okay? Now, let's say you're a swing trader. What are the probabilities? If you're a swing trader, that basically means you're trading off the 60, 120, or 240. Okay? If you're a swing trader and at the current bar you only have a purple dot, that's a low probability of success. Why? That support resistance is basically a day swing support resistance. It does not represent the swing long term. That's why you have a low probability there. If you have a cross, that gives you average probability, and of course the best solution is when you have a dot and cross where all three types of traders are thinking the same way. So what does this all mean? If you're a conservative trader, you're always looking for dots and crosses where the support resistances are across all time frames. If you're an aggressive trader and you're a swing trader, you're looking for a cross. If you're a day trader, the best solution for you as a day trader is to look for a cross on your day trading time frame. Okay, so that's a summary there. And don't worry, we'll go to some charts in just a moment. Here's an example of the iMTF representation that we're going to give you on a chart. You could see from this chart that we have these crosses here. Here's our swing crosses which are acting as resistance, and you can see prices below these crosses, so the cross is acting as a resistance. In some scenarios you're going to have two crosses, and you could see here you have a cross, and let me use the pointer here. You have a cross right here is one, and then you have a cross right here. So in this example here, you actually have two multiple time frame resistances that are swing long. Yes, you can have two levels, believe it or not. Okay, so those are there. So in this case here, you have two of them here. Okay, now which cross do you take to trade? If you took this cross, you enter the trade, but you waited for a second cross that never entered the trade. So what you always want to do is, if you took this cross right here, this bottom one here, and you put the trade here to short this trade here, then what happened is that price never got to the top one at all, and you missed this opportunity. So what you always want to do is, if you have two crosses, use the lowest one for bearish or the highest one for bullish type of scenarios. Okay? So taking the cross, but you always have to evaluate once you have those crosses and everything based on reward risk. If you don't see a potential 3-to-1 reward risk ratio with taking the trade off this first cross, then you cannot take this trade at all. Okay, but this shows you a clear example of a chart here where you had a cross and a dot on the same bar, which basically gives you the highest probability scenario for you. It doesn't matter if you're day trading, it doesn't matter if this is a swing trading time frame. Either way, this is still the highest probability scenario where the dot and cross represented a major resistance for this example here. Okay? And this gives you the visual images there. So that gives you an example of the charts there. Now we have discussed the iMTF support resistance. Let's discuss on when to look to place an order. We know the critical support resistance is now based on the iMTF crosses and dots. Now the question is, when do we need to sit there and place the order? What is the strategy? Where are the stops going to be? Where are the targets going to be? Where do we sit there and start protecting our profits? Which one gives us the best reward risk ratio? These are all questions you probably have in your mind right now. If you're an elite wave trader, what we're about to discuss is the big institutional wave, and that's the strategy we're going to discuss in just a moment. So, in the iMTF technology, we represent a bullish strategy zone by shading the background green. Okay, so whenever you see the background, in this example here, I have a white background for my charts. You could always use black. It doesn't matter. But what we do is we shade the background for a bullish setup green. Okay, the shaded area will stay shaded green as long as the setup is valid. When a setup is no longer valid, the shaded area will disappear. Okay. Number two, the point number two right here, what that does is it shows you when a shaded area occurs, you start seeing these small little blue dots. So during the shaded area, these blue dots represent the breakout entry. So if you're a breakout trader, you're going to be looking to enter this trade on a breakout at these blue dots there. Okay. Once you have your breakout entry, the next question is, what is your initial stop? And then what is your stop after you enter the trade? These green dots here represent the trailing stop. Okay, so you could see these green dots exist during the shaded area, so that'll tell you where your initial stop is, and they go outside the shaded area. So if you enter that breakout trade, you know exactly where your trailing stop should be at all times. Okay. Notice the shaded area here disappears here, and the reason why is that this price here got to the breakout entry. Once the breakout entry got triggered, the shaded area disappeared because this is no longer a setup anymore since the breakout traders have entered the trade. The other scenario where the shaded area will disappear is, let's say price never got to the blue dots and decides to reverse. So if price got to the green dots here, it cancels the trade, and at that point the shaded area goes away. So if price decided to reverse, then then basically the shaded area will disappear too. Okay. This is an example for a bearish setup. Just like before, what's going to happen is we have a shaded area to represent the setup. Since this is a bearish setup, we basically did it a light red color here for a bearish setup. The breakout dots are the same thing. They're going to be blue circle dots. Your stops are still going to be green, okay, and so forth. Now, that was, let me just quickly talk about this one here. So you could see in here that this is a setup here going down, 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 and you could also see here you have some crosses in this setup here. So this is a bearish setup here. Now, this is a good bearish setup, and you could see that price triggered the breakout on this price right here is when it triggered the breakout because it got to the breakout dot, and then you could see price going down. Let me give you an example of a bad setup. So this is an example of a bad setup here. Let's go for the bad one because this so that you could see this and you could avoid this situation here. In this example, you have a bearish setup here because it's red. That means you're betting on the instrument going down. However, notice the purple dots are acting as support here. Okay, so your bearish setup. So in the scenario here, you want the dots and crosses to act as resistances, not support. Because if you're trying to go down, you do not want multiple time frame supports interfering with your trade at all. And the problem in this setup here is that you're betting on it going down in a shaded area, but you have these dots that are interfering with the trade. And that's exactly what happened in this situation here. These dots acted as support, and price eventually sat there and went up. And it went up to a point, it got to the green dots, and the shaded area disappeared. And that's basically the other scenario when the shaded area goes away is when it reverses on you. You didn't even enter this trade at all, so you didn't lose or anything at all. The key thing here is that the shaded area disappeared. That tells you the setup is no longer valid at all. And what caused this was the day swing trading supports basically held price from going down, and it caused it to reverse. Someone had a question, will this work for Forex? Yes, it works for Forex, futures, and stocks and everything, and we'll go through some examples in just a moment here. Here's another example of a bad setup. Look at the location of the green dots when you have a trailing stop. So in this example here, you have the red shaded area right there as shown in point number 1. Price, you could see the swing long-term supports here. Okay, so you could see these crosses right there, which is basically the resistance at the top here for the shaded area. For a bearish setup, that's a great scenario where you have a cross which is in the shaded area, which is acting as resistance to support you. The problem you have is these green dots, these green trailing dots right there are basically below the resistance, and that's not good at all. Because If you're looking for a pullback trade, you're looking to place a sell limit order at these crosses there. If you do that, your stop is below you. You cannot have your stop below you. Your stop needs to be above you. So what you need is these crosses need to be below the green trailing stop, and if you have that, that's a great setup. So beware of these situations that can occur here where you have your multiple time frame resistance above the green dots. That's not a good situation at all, and that shows you basically a bad setup there. Okay, so we've gone through two different types of bad setups to help you avoid them. Okay, now here's an example of a consolidation pattern. This is not a bad setup at all. This is an example of a consolidation pattern that basically broke out successfully. Notice the shaded areas are close to each other. Okay. Also, notice price never gets to the breakout blue dots except on the last shaded area. So you have a bullish setup here. Price never got to the bullish breakout there. On the bearish setup, price never got to the blue dots here. On the green, price never got to the dots right there in the bullish setup. On the last one, it got to the breakout blue dots here for the bearish setup, and then it did sit there and go down. Okay. We had a question: why color bad setups? We have not optimized this indicator completely, so we basically have released this at a certain point. And the reason why we don't want to optimize the indicator completely is that there's different types of traders out there. In future releases, we will be offering a optimized version of the indicator, but right now this is what we have, and you could use it in different methods, and you'll see a lot of it once we go through some of the charts and start looking at other technical systems and how you could use this to apply to that. So up to this point, we've illustrated a setup which is a shaded area. The breakout entry is at the blue dots. The pullback entries are either at the purple dots or the black crosses, and the stops are at the green dots. So you have a complete picture of what the setup should be. The last item that needs to be discussed for a trading plan is the target or the price level where you tighten up your stop so you don't go round trip or take some positions off. The place where you tighten up our stop or take some positions off is what we call preserve mode. It is a term we came up with so traders don't go round trip. If you think about it, all traders are successful in their trade at some point. The problems most traders have is to keep that success and deal with money management. In order to determine targets in preserve mode, we're going to reference past iMTF support levels. Think about this. How powerful is this? Have you ever been able to see past multiple time frame support resistances ever? Today, you will. And a lot of people have never been able to see that because nothing's been able to compute that scenario at all. So we're going to go through a situation here, and we're going to go for some charts now, and we're going to show you how to find these past support resistance levels. Here's a monthly chart for the US yen spot currency. This is a monthly chart here, okay? And if you look at price, when price is going up, how the iMTF levels influence it. Most people reference the pivot highs and pivot lows, but the iMTF technology can easily see multiple time frame support resistances. So let's look at this chart here. Look back at the past. Does everyone see this cross here in the past? This was a cross of multiple time frame support that was established back in 2014. And if you draw a line here, you could see how it influences everything here moving forward. So you're now able to see these multiple time frame support resistances that occurred in the past, and you could see how easily influences you now. You no longer have to sit there and look at these pivot highs or pivot lows and wonder which one is critical. You could look at these crosses and you could see how critical they are, and it'll help you determine where your targets need to be or where you need to start protecting your profits as you move forward. Okay? And let me give you some examples more. Here's an example of the US yen 60-minute currency. Notice price was going down, 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 down here. Then all of a sudden it stopped, and then it reversed. If you look backwards, there was these crosses here which was dating back to late January of this year. Remember, this is a 60-minute time frame. And if you look, notice price never got to those crosses. There was no pivot there at all. But this was a multiple time frame support in the past that occurred. And notice how it influenced price here. Most people would not see this at all because price never got to those levels. But you could see how it did influence price action here on this time frame here and this date. Okay. Here's an example of WDC monthly time frame. Okay. This was basically a reverse trade here. It was a bearish setup that never triggered at all and reversed. And notice it's going up, up, up. How far can this thing go up? If you look backwards, it's hard to see. There's a cross right here on a bar. And if you look at it, that's pretty much where WDC is going to. And this is a chart from, I think, about a week, week and a half ago. So you could see here where this is going to go to, and at that point it's going to run into a major resistance. Do you think you would have found this resistance here by looking at pure price action? Would you have noticed that this is a multiple time frame resistance level right there on that occurred basically in late 2015? You would not see that with a naked eye, believe it or not. Here's a stock for McDonald's here on a daily time frame here. Notice price was going up, 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 up. Then all of a sudden ran into resistance here, consolidated for a little while, and then took off again. If you look backwards, there were these crosses right there that basically were established basically back in early August of 2016, which was influenced everything going into 2017. So these are multiple time frame resistances that were influencing you there. Okay. Now, what is your trading plan? What are the exact rules that we talk about? So let's go through that. So first, you go to your trading time frame, whatever it may be. 5 minutes, 10 minutes, 15, 20, and so forth. Then you wait for a green shaded area for bullish opportunities or red shaded area for bearish. If you like to trade only bullish, you look for green. If you like to trade only bearish, you look for red. If you're neutral, you look for either shaded area at all. Once you have those shaded areas, then you could sit there and look. This is where you could bring in any other technical system if you want. You could bring in Bollinger Bands, moving averages, Fibonacci, Elliott Wave, MACDs, whatever if you want. You could bring it in at this point, and you could use those other technical systems as optimization if you like. And we'll talk about those other systems and how you could use that with the iMTF indicator in just a moment. Okay. Then you place your order at the breakout or breakout dots, which are basically the blue dots. Okay, your conditional stop is at the green dots. Okay, you could apply any optimization technique at this point if you like. Then you put a cancel alert at the conditional stop, which is basically where those green dots are. So just in case it reverses, you'll get an alert and you'll know to cancel your trade. You don't want that trade sitting out there forever, especially if it reverses. Then you evaluate the reward risk for money management purposes. And then what you do is you verify that the entry and conditional stops are not sitting on existing support resistances. If so, move them off. Now, we have our formulas for the blue dots and the green dots. There's no way we could always make sure they're not sitting on existing support resistances. So we have a guideline for them, but we always tell you to verify they're not sitting on existing support resistance just to make sure. Okay? For pullback, very, very similar. You go to your trading time frame, wait for a green or red shaded area. Then you basically, you could use any other technical system to confirm there's a setup there. You put a pullback order at either the iMTF dots or crosses or both. Conservative traders will make sure that they only take orders at trades that have a cross and dot at the current bar. Then you have your conditional stop at the green dots. Any optimization you want, you could incorporate there. Evaluate reward risk, and then verify that basically your entry is not sitting on existing support resistance. Sorry, your conditional stop is not sitting on existing support resistance. If so, move it off. So that basically gives you the trading plan for both breakout and pullbacks. Now, let's go through and let's take two different approaches to looking at everything. One of the greatest advantages of the iMTF technology is that its ability to be used for any technical or fundamental system out there. It can help you optimize any existing system. You can use it with existing trading plan that you have and optimize it even further. It doesn't matter if you trade Fibonacci, Elliott wave, Bollinger Bands, moving averages, harmonics, candlestick patterns, or anything at all. This system can sit there and help optimize any existing system out there. So what we're going to do in this section is we're going to look at the iMTF indicator being used as an optimizer for existing system. And let's go for some examples. Here's example of a 240-minute chart for AEP stock. Notice there's a bearish trend going down with a black arrow. Okay, so this is a nice bearish trend that's going down. A lot of Fibonacci traders at that point would basically recognize this as a bearish trend, and at that point they'll do Fibonacci retracements on here and look for a trend to continue to go down. If the trader would draw the 50% and 61.8% Fibonacci levels for a possible bearish pullback to go down. And we've already shown you where the 50% levels are here and the 60% levels here, but with these bubbles here. If the trader put the trade on at either one of these levels, at 50% and at 70 or the 61.8%, they would have lost in this trade because price eventually went up. Okay. However, if you use the iMTF technology with Fibonacci, you never would have entered this trade. Why? In order to enter at the Fibonacci level, you need to have an iMTF dot across at that current bar. Since on a 240-minute, you would look for black crosses at least at these Fibonacci levels. Notice when it got to the Fibonacci level, there was not a cross here or a purple dot here at all. So at that point, you would not short it at the 50%. Then it got to the 61.8% retracement, and at that point, there was no cross there. So at that point, you would leave this alone and you would not trade this at all. So you would walk away from this trade here because you never had an iMTF multiple time frame resistance at the Fibonacci levels. So that in there, it helped optimize the Fibonacci system. Okay. Now let's look at AEP on a 60-minute with a Fibonacci retracement again. We have price here, got to a bottom, so price was going down, 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 got to a bottom, then reversed with a small bullish trend. This was right there. Even though this is a bullish pullback, some Fibonacci traders will look at this as a possible trend reversal trade and not pull back due to price action in a short amount of time. So they're looking for a bullish pullback here for it to reverse completely to go into a bullish trend. The black arrow shows the bullish trend here. The purple circle represents the Fibonacci levels here, right there. Okay. Notice at the 50% Fibonacci level, you had a row of crosses right there in the setup zone right there in the green shaded area. Notice, and that's what you're looking for. This was a confirmation at the 50% Fibonacci level that this was a multiple time frame support. If you do Fibonacci clustering, this did it for you automatically. Okay? So that's right there. So this was a high probability setup because you had a 50% retracement, and at that 50% retracement, you had basically the multiple time frame support, which was confirming it was not just a single time frame 60-minute support, but it was a support for across different time frames for both the swing traders and long-term traders. Here is a 3-minute chart for gold futures with Hakinashi candles. Some of you guys have used Hakinashi candles, some of you guys haven't. But Hakinashi candles, believe it or not, is a great, great tool on the NinjaTrader platform, and we use it a lot, believe it or not. Hakinashi candles, believe it or not, originated at the same time with Japanese candlesticks, but a lot of people don't know about them or use them. But I'm going to show you here what you can do with them. Okay, so here's a 3-minute chart for gold futures here with Hakinashi candles. On the breakout here, we're looking for a Hakinashi candle. When you look at Hakinashi candles, you want to make sure there's no wicks at all. So you want to make sure that on this candle, there's no wick at the top side. When you do, that tells us that candle is very strong. And it basically tells us volatility is there, and volatility has taken over the breakout trade, which is exactly what you're looking for with Hakinashi candles. Okay, so this occurred here, here, here. you could see there's no top wick here, no top wick, no top wick. There was a top wick here. So based on the Haki-Nashi rules, you would basically get out of this trade right there if you did based on their rules here. Okay. If you're basically off the green dots, then basically you're still in this trade going down. So you could use this in multiple different ways, but what you could do is optimize these breakout levels by making sure that the bar that breaks out here is a Haki-Nashi candle with no wick to the top side for bearish scenarios or no wick to the bottom side for bullish scenarios at all. Okay. Here is Harmonics. My good friend Scott Carney has talked about Harmonics here on NinjaTrader platform. This is an example with Harmonics with iMTF. This is a spot currency for the pound USD on a 30-minute time frame. So you have a harmonic pattern indicating a possible bottom and reversing. If you're using the iMTF as an optimizer, there's two approaches here. If you're an aggressive trader and want to enter on a counter trend bullish trend, then you're waiting for price to break the iMTF crosses right here, dots and crosses, and you can see that here. It occurs on a major resistance, you enter the trade, and so forth. So one setup is here, where if you're an aggressive trader, as soon as it breaks some major resistances here, as right here, then you're looking to enter. That's the aggressive approach. The conservative approach is wait for the green shaded area to occur, and at that point enter this trade here. And if you look, how far will this go? Well, it'll go to these crosses here, which is basically, notice this is a 30-minute time frame. So you're going to sit there and trade this all the way to these black crosses right there, which is basically where the swing long-term resistance is. Here's QCOM on a 240-minute. This is example with Bollinger Bands. This is simple Bollinger Bands with 2 standard deviations for the indicator here. Okay, and you can see the settings up here for the Bollinger Bands here. So you look at the purple dots here. Notice the purple dots. Notice the Bollinger Band was right here, was on the outside right there of the 2 standard deviations, and notice you had a setup here and a breakout here, and that basically triggered here. Then notice on this scenario here, if you're looking from a counterpoint trend point of view, then what happens is that you have a multiple time frame dots right here. In order for you to say it's no longer going to keep on going down, you need that resistance to be broken, and that's exactly what happened here. The resistance was broken, and then at that point it came to the top side here of the top of this 2 standard deviation, but notice those black crosses here supporting this. This basically supported it here to break out here. So this was a great scenario of picking a bottom here using Bollinger Bands and iMTF technology, because it broke the iMTF resistance, and then you had an iMTF support to hold it here at the bottom of the Bollinger Bands to basically get this thing to keep on going up. And notice when it went up, you had the shaded area to basically support it to keep on going up, and then you had some crosses here that developed a support to keep that trend from going up. So this is basically a great setup for Bollinger Bands going up. A lot of you guys are using moving averages. So this is an example of X stock here on a 60-minute using moving averages. So we have a 50-day SMA and a 200-day SMA. The 50 is basically the simple moving average is the red line. The blue line basically represents the 200-day moving average right there. Okay, and in this system, basically it's a crossover system where you're looking for a bullish setup when the 50 SMA crosses above the 200 and vice versa for bearish. The first bullish crossover occurred on the far left right here. So this is when the first bullish setup occurred here based on the moving averages. Okay, notice the second one is basically here where basically you're looking for a breakout right there. Okay. So how do you work this? So when the 50 crossed above the 200, you're now looking for a bullish setup. When this crossover took place, this setup, this green setup here was before the crossover, so you can't really look at this. You had a bearish setup here, but the moving averages were still indicating bullish, so you would not take that bearish setup. Then you finally got a green shaded area here. You put a breakout order here. The green shaded area disappeared. At that point, you walk away. Then you had a green shaded area here. At that point, you put a breakout trade. You got into this trade right there, and at that point you lost a little here because it never really took off. So, and then this trade here never triggered, and then you had another bullish setup here that occurred. This trade right here triggered, and it finally did take off here. So this was your one winning trade here that took care of the small loss here, and you still walked away with profits here. So basically what you're doing in this system by combining the systems is that you're only taking the shaded area directions based on the 50 and the 200-day moving average. Okay? Now, we've shown you how to use the iMTF indicator as basically an optimizer for existing systems. Let's show you how it could be used by itself. Well, what we're going to do is we're going to go back in history and we're going to show you all the major trends that have occurred, and we're going to show you charts where the iMTF indicator, just the shaded areas, we're going to basically, we stripped off everything else. We're not showing you the iMTF support resistances, nothing at all. I'm going to basically show you the shaded areas, the blue dots and the green dots, and I'm going to show you how powerful this is from a high-level perspective. So here's a chart, the S&P 500 index, focusing on between 2003 and late 2008, okay? And you could see the timeline down here. In 2003, we had a red shaded area, but notice it never triggered the breakouts at all, okay? The shaded area then disappeared here, and this was basically around late 2003 was when the shaded area disappeared, okay? And this indicated that we were going to reverse into a bullish trend or reverse into a bullish consolidation pattern or into a bullish trend. The next bullish setup would tell us which one. So this was the bullish setup here. If price never got to the blue dots there and triggered the breakout and reversed when the green shaded area disappeared, then you know that basically the market was going to consolidate on a monthly basis. But instead, what it did was it broke out here and basically at that point started a trend going up, 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 up here. It retested this high here and then kept on going up and eventually decided to pull back here and reverse a little here. Okay? So notice how we basically going and looking at this. Notice right here, this bullish trend here was basically stopped out late 2007 going into 2008 here, and at that point the 2008 occurred here. We'll show you the 2008 bearish trend in just a moment. This is XLK, the technology sector in 2008, okay? And why am I showing you this? I'll show you this I'll tell you this in a minute. Financials took the market down in 2009, but technology led us out of it. A lot of people didn't recognize that at the very beginning. When something goes down, something typically is taking us out of it. There may be a little delay period between the two, but if one sector goes down, another one typically starts leading us, and that's what leads us into a bull market. And you could easily see that here. Notice for the XLK, the technology ETF sector here, in 2009, right here, notice we had a bearish setup, but it never triggered at all. And then in 2011, it triggered right here, and notice that this sector at that point took off, and it's kept on going all the way to 2017. Okay? This was the XLF. And notice, remember, the technology sector never broke out. Okay? Notice the XLF in 2008 did break out on a monthly time frame, and it started a bearish trend. So this was a clear sign in 2008 where basically the financial sector was going down, but the technology sector was not. And if you look at it, if you looked at those two sectors, you could easily see the technology sector at that point bottomed out in 2009, 2010, and then basically started the bullish trend to go forward. This here, if you notice this here, this triggered the bullish setup in late 2014. And if you go back to the previous chart here, the XLK, the technology, got triggered in 2011, 2012. So if you notice that, that's a 2-year difference between two different sectors starting a bullish trend on the monthly time frame. This is great to sit there and analyze on a monthly time frame and see what sectors are leading, going forward, and so forth. Now, let's talk about Apple. A lot of people know about Apple. Everyone knows about it. And a lot of people kind of upset because they missed the big trend. Well, when did it start? Appleby has been in a major trend this entire year. The question is, when did it start? Here's a chart of the daily time frame here. Notice you had a bearish setup here in around December of 2016, never got to the blue dots at all. A couple of days later, in late December, it had a bearish setup here, and a bearish setup in January 2017 triggered, and notice at that point it has not looked back at all, and it's kept on going up, 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 up. This was basically when Apple broke out right there. Next is NVIDIA. NVIDIA actually has earnings today. You guys have heard about NVIDIA's trend going long. You could see here, around late April of this year, NVIDIA on a 240-minute time frame had a bullish setup here. And then it had some crosses in here. It basically triggered the pullback level here, and you could see the green dots here. And then basically earnings came out, and so all this occurred before earnings. Earnings came out, and then it took off with vengeance, going all the way up here and has not even looked back. Notice here it got to about 165, then came down, and then notice these crosses here developed here, and that weakened NVIDIA for a little while here. But notice it never sat there and developed a bearish trend at all with these crosses at all. So these are major resistances, but without a bearish shaded area, this never followed through to go down. When you finally got a shaded area here, the crosses weren't there anymore to help it go down. And as a result, it reversed here and then kept on going up, up, up. Okay? Here's crude oil. A lot of people ask, well, when crude oil was over $100 a barrel, what happened? When did it go down and so forth? This is a weekly chart of crude oil that goes back here to 2014, September, October. And you could see there was a bearish setup here. It triggered here, and you could see it went down, 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 down here, and kind of cut in half. But you could see the setup here, the breakout levels here were roughly around $110 a barrel, and you could see this triggered here. This is E-mini. A lot of people think that you cannot use the iMTF indicator for day trading or scalping. Here's an E-mini chart of July 2017. This is when we sent the PowerPoints to NinjaTrader. And you could see here, this is on the 1 minute, the bullish setup here occurred, okay, at the blue dots here. So you would enter here, but notice there was a resistance here. So if you evaluate the reward risk here, there was not a potential 3-to-1 reward risk ratio on the breakout trade here at all. So this is a trade you wouldn't enter at all. Then you had a bearish setup here. Oh, sorry, this is not E-mini, believe it or not. It's not E-mini, this is 6E, sorry. Sorry, I think, what is that? I can't even remember what that is. Either way, but then you had a bearish setup here, breakout here, and this goes down, 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 and that was your setup there. Okay, someone just pointed out this is not E-mini. I thought this was E-mini, but it's not. It's a 6E futures. I can't remember what that is. We'll look at it up later. Okay. Now, we have concluded the workshop. We had limited time, so we could not show you all the iMTF technology and all the instruments and time frame. The technology works on all time frames and all instruments, from stocks, currencies, bonds, believe it or not, and so forth. If you could chart it with the technology, it works, basically is what our philosophy is. Okay. You could sign up on social media on our website and watch the trade setup videos. So let me show you this. So here's our contact information. If you go to the website here, you could sit there and go and look at our blogs. You could see us using the iMTF technology for various instruments and various time frames for both breakouts and pullbacks. Last month, we even published an article on how to predict high probability tops and bottoms with the iMTF technology too. So you could find all these articles and everything on a blog on Ichimoku Trade. Okay. Now the big question everyone's asking, how do we get it and how much does it cost? Okay. Well, here it is. So believe it or not, we have gutted the price for this product, and we're releasing it for a special promotional price right now for $99 a year. That's it. It's an annual subscription. We're doing it for $99 a year. And that's it. If you're interested, all you have to do is go to this link here, which is www.imtftrade.com/NTIMTF, and there's an order form there. Couple of things to note. You must include your machine ID in the order form. If you do not include the machine ID in the order form, then it'll delay the process for us to activate the license. Okay? The activation of the license, depending on how many orders we get, can take anywhere from a couple hours to 48 hours. Reason why is there's a lot of people purchasing this indicator, so you need to give us some time there. Okay? Also, once you indicator does not take time to load since it's calculated. So what this basically means is that the indicator, when you pull it up, will take some time to load. If you're expecting the indicator to pull up within a second, that's not going to happen at all. Okay, it does take some time because you have to understand we are crunching from 1 minute all the way to monthly time frame, all the price data action for the current bar and every historical bar that you asked for. So it does take some time there to load that indicator. So please do not sit there and expect that at all. That's some issue we've had. I want to make sure in beta testing that, there was an issue that we had in beta testing that I want to make sure you guys understand. It's not a 1 second load time at all for the indicator. Okay. There's an installation video too that you'll get after you order it. Also support, since we're offering a really cheap price, is via email. And it's typically, we say 3 to 5 days, but it's typically 1 to 3 and from there. So the other thing I will do is if you order before 6 o'clock, everyone that orders before 6 o'clock p.m. Eastern, actually, let's say 7 p.m. Eastern Standard Time, I will do a special promotional webinar next week where I will show you our seasonal application, which is free. It's a mobile app that we release for seasonality, and I'll show you how to use all that data with the iMTF indicator to increase your probabilities even more. The machine ID, if you go into the NinjaTrader platform, click on Help in the menu option, and then choose About. It'll give you all the information, what version of Ninja you're running, and in one of the sections it says Machine ID. Also note, this is only available for NinjaTrader 8. It is not available for NinjaTrader 7 at all. Okay, and it's $99 a year lifetime. Once you lock in, that's pretty much it for lifetime for you guys. So it's an annual subscription. If you cancel, then yeah, it won't be lifetime, but it's an annual subscription that pretty much renews year after year. And trust me, a lot of people asked us why we're charging so cheap. Well, the key is that I want to sit there and help retail traders turn that corner. And I want to show people on what multiple time frame analysis could do and how it could help you with your existing system or by itself within itself. A lot of people don't believe these multiple time frame levels. Well, we're giving you an entry point now to test everything out yourself and validate everything yourself too. Someone's asking, if I purchase in 6 hours, what bonus will you give you? So like I mentioned, I will give a bonus round where I'll do a special webinar with everyone that purchases indicator by 7 p.m. Eastern Standard Time, where I'll do a special webinar with them next week on seasonality. Also, I may do something else with combine, also show you guys how to use Hakinashi candles too, since NinjaTrader has the Hakinashi candles and a lot of people have not heard about it or used it at all. This license is for one machine only, so it's $99 for each license for each machine. Yeah, Gary, it says 3 business days to activate. Typically, it's within 24 hours, but it depends on how many orders we get and so forth. So we give ourselves some time. Instructions: once you get you order the indicator, you will get a video with instructions and detailed instructions on how to install it. Also to troubleshoot if you run into any issues. And then it'll also guide you on to the iMTF tutorial workshop. If you guys have any issues at all, you could basically give us a call at this phone number here that you see at the bottom. It says US, or you could email us at info@eiicapital.com, and we'll basically get back to you. Any other questions? I know we went through a lot. Hopefully everyone will be able to absorb it.
All right, Manesh, there's quite a few questions from earlier. I think, does anyone want to re-enter any questions that you have that maybe didn't get addressed?
There's one question that says, how can I combine it with Ichimoku Clouds? We'll show you that next week too, but you could use Ichimoku basically to optimize it. But Ichimoku is one of the fundamentals behind the iMTF technology that it does use. So if you're going to use Ichimoku, you could basically apply the iMTF and then, apply the other iMTF, the Ichimoku indicators such as Shikao, the lagging span indicator, and use it for optimization. James, it depends on how much historical data you load. If you're not loading too much historical data, it may only take 2 or 3 seconds to load. If you're loading 10 to 20 years and you're asking for 1-minute data all the way up to daily time frame data for all those years, then it's going to maybe take, about 10 seconds or so load. Charles, if for the people that are NinjaTrader 7, and if you're flipping over, and if you're interested and you want to lock in the price, just send us an email and let us know that you are changing from NinjaTrader 7 to 8, and when you're going to be doing that, and we will lock in that price for you for that period. Joe, yes, it will work with no other indicators in just a 5-minute time frame. As you saw from a lot of my charts, I just had the iMTF indicator with pure price action, nothing else. No, it doesn't come with a cloud. The Ichimoku cloud you guys can find on the NinjaTrader forum. We are in the process of creating our own little cloud, and we will be releasing that probably in about a month to 2 months' time with some functionality in there. Joe, if you guys are having problems with putting the machine ID in there, you could just fill out the form and then send us an email, and then we'll connect the two if you can't see it. Any other questions? If you guys also look today, we put out on social media 2 E-mini trades on the 240-minute with the iMTF indicator. So there was actually a bearish setup today on a 240-minute that triggered on the breakout level and it went down. So we did publish 2 E-mini trades off of 240 minutes on our social media. And if you want to go to social media, just go to the website, ichimokutrade.com, and click on one of the social media icons at the top, and you could connect to Twitter, Facebook, or whatever, and you could see our social media blogging. David M., what were your 2 questions? When will the recording be available? Jared, where and when will the recording be available?
Sorry about that. Yeah, the recording will be available on either Friday or Monday.
Well, So Barry, what I mean by that support resistance anymore, we're calculating the key support resistance levels for you now. That's what those crosses and the dots represent. Remember, everything a lot of traders are doing are single time frame support resistances or 2 time frames or at most 3. With the crosses and dots, basically that represents multiple time frame support resistance levels. So you could use that for confirmation for a breakout trade or use that for pullback entries. David M, yeah, the $99 a year promotion we will keep active for a couple of days after the recording is released, so that's not going to be a problem.
All right. Well, I think if you're okay with it, Manesh, I'd like to wrap this up. We've gone well over our time today, but I know everyone enjoyed the presentation.
Sorry about that.
Oh, no worries at all. So I'm just going to do my kind of typical outro here. I do want to give a special thank you to Manesh Patel of Ichimoku Trade for his great presentation today. The NinjaTrader ecosystem is pleased to sponsor these weekly vendor events as a value-added service for our clients. If you find value in these events, we hope that you will attend on a regular basis. Right now, we do one per week, which we email out about currently. I do want to remind everyone that the information provided in this presentation was that of Ichimoku Trade and not of NinjaTraders. All information was for educational purposes and should not be construed as trading advice. Again, we appreciate the time you spent with us today. Please enjoy the rest of your day, and we hope to see you in future webinars. Happy trading from all of us here at NinjaTrader.